Ladies and gentlemen, welcome back to my video. It's me, Muhammad Noval, and I think it's been a while since my last video of international business mind map. And in this video, I'll be showing you another mind map of corporate finance in IPMI International Business School. So let's get into it and enjoy the video. Corporate finance course in IPMI International Business School was taught by Professor Isambol, a renowned financial expert and securities analyst in Indonesia. Now, the first week is all about the basics. So first, we learned about the cash flow between firm and financial market, and then we learned what good corporate governance is and the principles behind it, which are transparency, accountability, responsibility, independency, and fairness. And also we learned about the basic of principal agent problem and what causes it. Well, there are three causes. First is asymmetric information, the second is moral hazard, and the third, conflict of interest between the principal and the agent. And the next, we learned about the basic of capital budgeting method, which includes net present value, profitability index, and internal rate of return. And last, in the first week, we learned about value creation in terms of cash flow, and there are four principles on value creation. The first is core of value, the second is conservation of value, expectations treadmill, and best owner principle. So that's about the basics of corporate finance in first week. Into the second week, we dive deeper into the capital budgeting method. So what we did first was doing some practices on capital budgeting cases, and then we learned about time value of money, which includes future value and present value. And then we were warned about investment fraud and how to avoid it. So basically, we need to consider three things. The first is that the business should be legal, and the salesperson should be certified, and the product or the service of the business should be legal. And last but not least, we learned about benchmarking of stock prices based on three things. The first is on price to earnings ratio or P ratio. Second is price to book value or PBV ratio, and the third is the number on the stock price itself. So basically, we want to determine whether the stock price is cheap or expensive based on these three things. And that's the second week of corporate finance. Now into the third week, we learned and were introduced into fundamental analysis. So what we learned first is about capital rationing, and then we are introduced about the fundamental analysis and what kind of analysis that could be done. First is about domestic and global economic analysis, the next is industry analysis, and the third is the company analysis. Next, we learned about intrinsic value and market price and what kind of decision that we can make based on the difference between those values. And next, we learned about how to analyze financial reports. So basically, this is the summary of accounting course that we had before in balance sheet, income statement, and cash flow statement. And next, we learned about financial ratio that also have covered in accounting in 5 different segments: profitability, liquidity, activity, leverage, and market ratio. And lastly, we learned about decomposition or DuPont analysis in common. And this is basically we took out some profitability ratio and decompose it into other financial numbers. So we analyzed and we need to find out what went wrong with the company's financial based on this decomposition. And that's the third week of fundamental analysis. Entering the week 4, portfolio theory. So we learned about return, the potential or the future return, historical or the past return, and required return. Next, we learned about risk, and in security there are two types of risk: the systematic and the unsystematic. The systematic risk is the risk that is inherently applied in the market. The unsystematic risk is the risk applied to a specific company or security. The next is about correlation and diversification. This is related to strategy on how to minimize unsystematic risk. Then we learned about how to calculate expected return or the capital asset pricing model based on 3 variables: market risk premium, risk-free rate, and the beta of the company stock. Next, we learned about capital structure theory that constituted by debt and equity. And next, we learned on how this capital structure affects the tax effect and financial distress, basically on the tax shield and the possibility of financial distress. So that's the fourth week of portfolio theory. Now in week 5, we learned and analyzed more on case studies. We had 2 cases. The first is leverage buyout of RGR Nabisco in 1988, and the second is how to survive and transforming business during financial distress. So in leverage buyout of Nabisco, we learned about leverage buyout processes and how does RGR Nabisco was evaluated based on the discounted cash flow theory, and what is the impact of this leverage buyout to the US bond market in early 90s. These cases were very interesting. And the next is we learned about surviving and transforming business during financial distress. And these are the steps. The first is stop the bleeding. The second is restructuring the financial. Next is do some temporary pivoting. And the fourth is strategic realigning. And next is we redefine the core of the business itself. And next is inventing and innovating the new ways of doing business. So these are what we've covered in week 5 on case studies. Now into the week 6 of fraud and trading. So in this fraud section, we were introduced about unethical and illegal practices and what's the difference between those two. We also learned about fraud and abuse. What kind of fraud? There are 3 types: corruption, asset misappropriations, and fraudulent statements. We also learned about fraud triangle, which is perceived pressure, perceived opportunity, and rationalization. Perceived pressure means that there is pressure. Perceived opportunity means that there is an opportunity to do fraud, and rationalization is basically the justification to do this kind of fraud. And next we learn about incentives and the 4 types of it: physical, monetary, social, and moral. And last is about whistleblowing. And in trading we learned about foreign exchange market. The strategy of arbitrage includes locational, triangular, and interest rate, and also the international arbitrage. So we learned about currency futures and option market, what is future contract, what is options, and how to, or what is call, what is put, how to do call and how to do put, and what is premium options, what kind of factors affect to the premium, and the strategy of long and put options. So this is the week 6 covering the fraud and trading. Now the 7th week or the last week of the course is on hypothesis of market efficiency. But first we learned on why public companies should pay dividend. The first step to prove that the company generates income. Second is to prove that the company's income is real, not only in report. And last is obligated by the regulation. Now on to the market efficiency. It means prices reflect all available information. Well, what kind of information are those? Well, those are historical trading data, publicly available information, and all public and private information. And now it comes into the random walk theory that states prices reflect all available information. Prices react instantaneously to new information, and new information is unpredictable, resulting in random movement price, or random walk, random movement of price. Yes. Next is about perfect capital market. These are the criteria of a perfect capital market. Those are perfect competition, no entry barrier, financial assets are infinitely divisible, no transaction costs, all information are available and free, no tax asymmetries, and no restriction on trading. But in reality, there are imperfections that makes the capital market is not perfect. Well, the imperfections are asymmetric taxes, asymmetric information, and there is transaction cost. And that is the 7th week of market efficiency hypothesis. So beside Then classes, we also have tasks, two major tasks. First is investment simulation, and the second is financial events. For investment simulation, we picked some stocks and hold it for 5 weeks and find out what kind of return or what returns that we get after 5 weeks. The next is about financial events. There are four types of events that we have analyzed. The first is company restructuring, second is rights issue, third is stock split, and initial public offering. So these are basically the tasks that we have done throughout the courses. And that's it, the video, guys. I hope you enjoyed the video and learned something from this, and I'll be seeing you in the next video. Thank you.